Hey, yo, what's up, Outliers? Bit of a fun day out there today. I think I've seen a few people hit me up. It's actually funny. I feel like people hit me up sometimes looking for reassurance, which, funny enough, that's not what you're going to get from me, because if you need reassurance for what the market's done over the last couple days, you're kind of in the wrong space. That being said, there definitely is some interesting market activity going on that we 100% need to discuss. So that's the game plan for today. I want to talk about a few things with you all really quick, run through a few announcements and see how everybody's doing. So let's run through our agenda. Before we get too far into the agenda, as you know, we got to say hello to everybody. It looks like we got Reese, Hater, Dark, Mark, Lauren. Good to see everybody. And I hope everybody's enjoying your kickoff to the week. I think weeks like this tend to be pretty interesting, and the next couple days are going to be important to us. So we'll talk a little bit about that. Now, let's talk a little bit about the stuff I want to cover today. First things first, I shared 2 different Google Forms in the Discord earlier today. And for those that don't know, every single quarter, I make the effort to get direct feedback from literally everybody. And it's work for me. I really don't get a whole lot out of it in terms of helping grow the channel. But the work is so important to me because it's how I get a sense of your interaction with either the Patreon, the Outlier Pro side of things, or the YouTube side of things. I care about both a lot. And it goes back to the point that I am now a 2-man band. It is 2 people in the band because I do have an editor. But other than the editor that literally just edits videos, it's all me that does literally everything. So I have a finite resource of time and effort. So I want to make sure that I'm spending that resource on the things that are genuinely most impactful to you. So it's like functionally in your best interest to give me honest, direct feedback so that I can continue to innovate, make things better for you. So the first Google form I'm dropping into the chat now. This is for the Outlier Pro members. So these are the folks that are in the paid side of things through Patreon. Let me grab the form here. I have to cut down how long it is because it's cutting it off. So that one is for the pro members. And then this next one I'm going to drop in is literally for everybody. So if you interact with the streams, the newsletter, the Discord, all of that stuff, that's what this second form is for. So genuinely appreciate anybody that takes the time. It is kind of self-serving on your end if you think about it, because this is how I know the stuff that's useful to focus on for you all. So that is that. The other 2 things I want to highlight quickly. First one is our leaderboard. So this is our current Discord leaderboard for February. At the end of February, so the first day of March, we will announce the winner, who will be randomly selected via ChatGPT. And everybody that's in the top 10 is essentially entered into the random giveaway. And this is literally my way to say thank you, and then also to incentivize your participation in the Discord. Because for most people, the Discord is going to be driven by you all sharing information with one another and interacting with one another. I spend my time sharing stuff here, right, on YouTube Lives. So I'm not spending a ton of time going into Discord personally to share my thoughts, because it's going to come out in this vector. Again, go back, 1-man band, limited time and effort. Now, most of the time that I do spend on the Discord, it is split between the pro section and then the free section where everybody is. So I do my best to interact with everybody, but it's the people that spur the conversations that's really important. So these are the folks right now that are in the running. And this is literally every single month that we do this now. So super stoked on this. Congrats to those in the running. Okay, now the last thing is early look. I haven't made the video yet, but I'm going to make a video soon announcing a little bit of a celebration and a giveaway. So I never used to do any sort of milestone stuff for the YouTube channel. Like if we hit 5,000 subs or whatever, I would just make a post and kind of use it as a point to reflect. But I actually think the community is getting to the point now where we're hitting, again, nowhere near big numbers, like, right? Let's fucking keep it real. But for what we are and what we do, I think it's awesome. So the way I'm doing it is now in 10,000 increments, we're just kind of doing like a themed live stream. So we're coming up on 30,000 and we'll do a themed live stream. It's going to be giving you an inside look at just the channel, because I watch a lot of YouTube myself pretty much all day. I have it on in some capacity. And I'm always interested in what it looks like for them to do what they do. It's super, I don't know, I just find it interesting. It's super curious to me. So we'll spend a little time talking about that just to give you a peek behind the scenes on essentially what I do and how I do it. And then I want to also split that live stream into spending a little time talking about like just trading war stories, because I don't spend a lot of time doing that. And it's because I think individual data points are generally not that useful, but some of them can be actually kind of fun. So I'm not going to focus on the stories that are, you know, making buckets of money and stuff like that. I don't care so much about that, but I want to talk about like the funny and interesting stuff. So I have a couple stories for you guys there. And we're also going to announce a winner. So essentially, I'm going to post a video that will include instructions for a giveaway. And then the winner will be announced during that live stream. And it'll be for a 1 hour one-on-one session with me to do a completely comprehensive overview of your trading approach, your strategies, what you're doing, and then to help you optimize what you're doing. So I think that'll be super fun. I'm excited to do that. So that is literally all of our updates. It is now time for the good stuff. It's time to take a look at the markets and see what's going on out there, because there is a lot. You'll notice that I spent a little time in the beginning of the stream. I actually started it early, and it's because I was literally listening to that video. And the reason why that video matters is because they're talking with, that was France, and they're talking about the potential resolution to the Ukraine-Russian conflict, which is very important. The way that that goes is going to be very important. So both from my general interest from a military lens, but then also from a market lens, I am quite interested to see how we eventually reconcile on that. So that's why you were listening to that. They think that they're very close to coming up with some sort of arrangement. So we will see what that actually looks like. So let's get over to the main screen, and I got to pop open a window. It's like, apparently it's decided to be summer here. So now it's kind of hot. So let me open my window real quick. That is much better. So see real quick if we have any pro questions. We don't. We are good on those. And then I guess 2 other announcements while we're in the sheet before I close it. For the skills development session, which is every single Wednesday, we spend time on that YouTube live stream working on like a basic skill. We're going to talk about the Outlier trade process. Now, again, this is not the only way to do this kind of thing. It's the way that I think about it, and it's to give you a framework to think about it. So a little bit of prep homework for you. I'm throwing it into the chat. I have a video that literally talks about what this is already. And the main thing I want you to think about with respect to this trade process is how we use it and the way that we build ideas. So that is what this will be all about. And like I said, we'll spend time getting into the weeds on it, but there is a little tiny bit of prep work ahead of time. It's really just so that we can be as efficient as possible. And now I don't know why I can't get rid of this line. That's kind of annoying me. Okay, that line lives there now. And the other thing I wanted to show you quickly is what we are talking about on Friday. So the Outlier options trading basics topic for Friday is this one here. So we're going to be doing navigating the options chain. So for those that don't know, I spent a lot of time looking through options chains, and it's because you can learn a lot. You can come up with different inferences based on how the volatility surface looks like, or unusual options activity, or if we see discrepancies between volatility relative to different strikes in terms of skew. So it's very cool to have an understanding of how to use options, and it's why you'll actually find a lot of professional, like true professional options traders from the institutional side. They don't look at charts. They couldn't care less about charts. And a big reason for that is because all of that information generally is baked into the options chain. So that's what we're going to talk about on Friday. So now we can successfully close this bad boy out, and let's talk about today, shall we? So from a high level overview, we saw a pretty, I don't want to call it nasty because it's a little dramatic, but definitely a successive pronounced pullback. And a lot of this is being driven by tech. Here's a really big problem that the market has right now, and we've talked about this several times. If we take a look at the broader market stance, the overwhelming majority of market performance right now is tied up in just a couple sectors, right? And you can see that if you look at tech's behavior, literally over the last 2 days, I mean, it is shedding. So this is one of the issues, and I've experienced this myself. I posted it in the Discord because a lot of my core allocation capital is in levered index ETFs, both SSO and TQQs. Well, even if you're in something like SSO, well, let's just start with SPY. Even if you're in SPY, you're essentially in tech at this point, which is kind of crazy, but it is absolutely the truth. So if we go to the fundamentals here, yeah, it's even more. 31% of that entire ETF, that index, is now in tech. So it used to be, if you wanted to get really strong exposure to tech but still be in an index, you would have to go into XLK or you would go into QQQ. The NASDAQ is even higher tech than this. So if you think of it from the perspective of index ETFs now, they're not even that diversified. So that's one of the reasons why you see the market looking as gnarly as it does in the short time frame. It's not that this is actually happening across all the sectors. There's actually sectors that are clearly showing strength, and it's important to identify that because a rotation of an individual sector that's bringing the majority of an index down is one story. Another story is that if we look at an index that's being brought down by the majority of sectors propped up by a few. So understanding this difference gives us a lot of context with respect to positioning. And it's going to help us understand how do we think we want to set up our portfolio? What makes sense for us to have out at a given point in time? But it's really important to reiterate this note, because it used to be not all that long ago, fucking 6, 7, 8 years ago, you would look at the broad sector, even for S&P 500, and it still was tech heavy, but it was nowhere near quite as heavy as it is now. And when you would see the entire S&P 500 having a not insignificant size day, you would start to think like, okay, yeah, there's kind of something pretty significant going on right now. But if we take a look at what happened today, it started at 602. It landed down at 597. So a pretty small move overall. But again, most of that move is going to be driven from tech. So something to keep a really close eye on, to summarize all of that, is if we start to see this broad weakness heavily extending into everything, into healthcare, into financials, into comm services, which has been the yang to the technology sector. If we start to see those relationships breaking down, that's a problem. But right now, this looks like profit taking. This looks like taking risk and just reallocating it into more cyclical kind of things. So if you take a look at Staples, Staples is now the leader compared to discretionary, which for the longest time, that was the invert. And this is a more defensive style play before people maybe think about moving into cyclical. So everything right now looks to be starting to dump closer and closer into defensive names. Now, utilities also down today. Interesting. Now, I do think that when I look across the market as a whole, I'm still carrying net long beta weighted deltas. However, I did start phasing on some shorts on Friday, and a lot of those shorts were really designed to be prospecting positions, because you never really know if there's going to be a bit of a continuation, which I have to be honest, I didn't expect there to be. Or if there is a continuation, they're generally not that long. So when I put my original round of shorts on Friday, those were kind of like prospecting positions. That means there are things that I pretty much expect to lose on, but I'm getting in a little bit earlier than I typically would with an actual position. And it's a timing thing. It's just not knowing. So that's what we have to do when we don't know. And then today was reinforcing a lot of those positions. So I do have a fair position now total in short beta weighted deltas. This is not in the context of trying to hedge my portfolio. It does inherently hedge the portfolio, but that's not the purpose of it. The purpose of it is literally so that I can play the near-term move. And I make that differentiation very purposefully. And it's because a lot of retail traders get into the disease. It literally is a fucking disease when retail traders start just not liking any risk. That does not work in this business. If taking risk makes you uncomfortable, you have two choices, and only two. Get the fuck over it or do something else. Those are your two choices, because our job as a trader is to take risks. Now, you'll see this all the time when you go on places, as you know, I spend time on Reddit and other kinds. Well, that's really the primary online community that I'll spend time with, and it's because it's already very curated, right? There's an options subreddit, which is, primarily what I do. And I'll come across stuff in there all the time where people are just looking for different methodologies to hedge. How do I reduce this risk? And it creates a completely false expectation of how this whole thing works. And it literally sets those kinds of traders up for failure. That sucks to hear. But the reality is your edge as a retail trader is not so fat that you can perpetually hedge against every 5% market down move. That's not a fucking thing. It doesn't exist for you. So to understand and acknowledge that then helps us try to figure out different methodologies to manage risk, because I will always remind you, literally the best possible methodology to manage risk as a retail trader is through sizing. If you size things appropriately, then you don't really need to hedge. If you are sized inappropriately or appropriately taking leverage if you want, then you do absolutely have to consider taking on a hedge and dragging those returns. But the drag on returns when you have a leveraged position is a different story than simply having trades on that you just get a little uncomfortable when they're red. that's not it. That is not it. And if that's you, it's okay, because you can work around and develop a healthier mindset towards risk. But if you stay in that comfort bubble, you're not going to find any profitability in trading. If you think about just standard market beta itself still has not insignificant risk with pretty serious drawdowns every once in a while. So let's use, this will be faster than me running it in Python. Let me grab Portfolio Visualizer right now. And you guys know I really like this tool. I think it's awesome. And I just want to show you this exact point, because traders commonly, who doesn't want everything? We want something that returns better than the market, but then we don't want to take the risk to get there. If you frame it that way, all of a sudden it sounds kind of fucking dumb, doesn't it? Like, that sounds pretty good. Like, pretty damn good. But like my grandpa always told me, if something seems too good to be true, it probably is. So let's take a look. Let's just take a look at standard market beta. And let's contextualize this. So if we go into SPY, or not, we're going to nothing. We go into SPY and analyze the movement here. We can look at and actually calculate the compound annual growth rate, right? So we can see what the overall risk is, but this will also show you drawdowns. Here. So if we take a look at downside deviation, it'll move around 2.8. The maximum drawdown that you had was 24% in this time frame, and this time frame wasn't that nasty, by the way. So without getting into skew, the kurtosis, those kinds of metrics, what I want you to pay attention to is that in the pursuit of getting your standard return, and let's see what that was here in this context, 14%-ish for the period, 14.59%. So its compound annual growth rate was 14.6%. So to get your 14.6%, you had an 18% down year, and you also had a 24% drawdown. Yet, there are still traders out there under the guise that they're going to be able to smash the performance of the benchmark and have less risk doing so. I regret to inform you, Santa Claus also is not fucking real. And neither is this. Now, what we can do is structure a portfolio that makes sense and that's robust and resilient, so that as it goes through drawdown and as it experiences risk, it's tolerable and it doesn't hurt us. That's good. So all that stuff aside, let's take a quick look through and see what comes to our mind. Well, a few things really stick out to me. Right now is a literally perfect time to start setting alerts. I have more alerts on right now than essentially ever before. And what I'm doing is I'm just perusing through a watch list of things that I'm interested in, and I'm literally tracking them on their way down. So IonQ is one that I'm interested in, and it's actually up a little bit today, interestingly. IonQ is a ticker I'm interested in. I really do want to gain exposure to this. So what I'm doing is I'm setting all these different alerts so that as it starts to gain life, and I actually need another one now above the point of control, as it starts to gain life, I will know about it. And then I can start phasing into positions to the upside. But right now, Take a look at Amazon. When did we spoke about Amazon a while ago, back when it was like up here. And we had talked about, I want to put a ratio call diagonal on in here because I like Amazon. But the issue is when this was happening, it was impossible for me to rationalize it. It couldn't be rationalized at this juncture. And I haven't redrawn this line, and it's just been cratering. Now it just closed below a 100-day moving average, and it has a ways to go at this point, which is actually a little deeper than I would have expected. But what I can tell you is, man, am I fucking glad that I didn't get into this way up here. I have no problem waiting, accepting the fact that I will never bottom tick stuff or top tick stuff. Even the shorts that I put on Friday, like I told you, those are prospecting positions. So those are positions that are put on to gain exposure, but they're not sized up as like full trades. And it's because, again, uncertainty, working with an ambiguous environment. Now, today I was able to scale in, but guess what that means? Even though they were showing a profit from Friday into today, they're not showing anywhere near the size of profit that they would have if they were full-size trades. That's the drawback of my style of trading, is I don't wait for excessive confirmation, but I absolutely wait for base level confirmation so that I'm not playing the game of putting trades on that continually move against me and stop me out. That just increases transaction costs, which for larger portfolios is kind of annoying. Because even to put on trades at size, even with pretty solid negotiated commissions, is not easy. So you get in a bit of a sticky spot with a portfolio trying to phase into a position. Now, this here still looks interesting, but this is no good. This is not a company that I would want to take to the short side personally. I like Amazon, and I think that in the longer run, they're way more likely to look solid, but not right now. So this is another example of just taking a tactical pause. This is the same thing in this QBTS. QBTS, I liked it, and it actually looked like it was starting to behave well. And it still might, because it's still in a general ascending pattern. But now what I need to do is set up a bunch of alerts really quick so that I can monitor how it behaves against this broader trend line that looks to be developing from here, kind of down here. Not so much. I would prefer to draw it from here. I think that this is more relevant. So this is now another one that we need to watch, or at least I need to watch. But this is also a wait. And then there was another one that we came across last night in the pro stream that I'm also interested in, is VST. And VST, again, another name, looks good overall, strong company in general, overall. Right now, that ain't it. So what I'm finding, and the reason why I'm going through this kind of annoying process probably to listen to, because I'm saying the same thing about different names, is I'm trying to show you that looking at different things right now, I'm seeing generally the same thing. So that tells me that this is not a really solid time to be prospecting on new trades in terms of bullish direction until this digests out. Now, I still do have exposure, like I've already told you, via the coverage triangle and a couple other ratio call diagonals. Like I still have that ratio call diagonal in Palantir. It's looking ugly now. It's no longer in profit at all. It was in profit previously, but not no more. And unlike like what I've been doing with the coverage triangle and phasing out of the profitable position as it's contracting so that I'm locking in a profit and decreasing total risk until I get to my desired risk allocation, which is what I'm at now. So for SSO, I'm in 13% equity. T-triple-Q's 12% equity. This is of the total allocation. And then IBIT down to 14% equity. That was over 70% previously. So most of the risk that I'm carrying right now in all of these is through the cash secured puts. Now, one of the notes though is I absolutely am willing to continue phasing these positions on. The problem is I can't fully rationalize it right now. And what I do is I set alerts so that as they start to recover and look healthy, then I can get back in. And the reason why I use short puts is because it's a way for me to monetize the downside move, the expansion and volatility. Most of those, I mean, I'm about 54% utilized in TQs, 50% utilized in SSO, 48% utilized in IBIT. Yet for all of them, the cheapest premium return on capital that I'm getting right now for the duration, which is 30 days for most of them, around 30 days or so, is over 3%. So it means that on those puts for the allocated capital, I'm making 3% of the money. And that's okay for me. Now, that's not going to pace if the market is flying, which is why I phase into equity during those phases. But this is exactly how I use two different methodologies, well, three different methodologies in one strategy. When I'm trading the covered strangle, I'm trading via dollar cost averaging, short puts below basis, value averaging, trimming off risk from selling equity position as I get favorable moves, and then also risk premiums through the short options legs. So maintaining that total split, it gives me a way to make money, even though, for example, while I've been in T-triple-Qs, the underlying has had a 6.5% positive move from when I first entered, but the covered strangle position that I'm in right now is up 11.2%. So it's almost double. And then if I look at SSO is up 0.33%, and the return on invested capital for the covered strangle is 2% as of now, which is obviously with that contraction. So a lot of these that's based on the open position as well, by the way, because I've phased out of quite a lot of these. And it's just so that I'm not holding stuff as it's going down. It's bad practice. Tough way to make money that way. So that's what I'm seeing in general. Now, we can take a couple minutes. If you have specific questions that you have, now's a great time to do that. I probably have like another 10 minutes or so before I got to hop off. If there's specific things that you would like to look for, happy to do that now. But I think the market, to summarize all that, we're at a point where we need to wait and see how this settles out. I'm not a big fan of the recent price action in SPY. It's aggressive enough and broad enough that this is why I'm not nibbling on the way down. It needs to normalize a little bit. Dark Jen says, look at GME, exclamation point. Unfortunately, you're missing literally the golden way to phrase that. The way that your grandma would force you to phrase that in order to get what you want with a higher likelihood. So we'll see if you can spot your error. There you go. Of course we could look at GME. Let's do that. Bad. Yeah, GME's bad. So I will still do my GME update video tomorrow. I literally talked about this exact expected behavior, right? To move into these value areas. The dip below is not too different than what we saw here, right? With price challenging some of this to the bottom end, but it's now closing below really long-term moving averages. Breadth is not looking good. It's effectively rolling over. So we need to see if it starts to consolidate anywhere in here. And if so, great. but right now it's simply not. So it's been on a pretty steep decline, even given its slight breath of air on Friday. So I'll do a deeper analysis with GameStop tomorrow. If you have any specific questions on it, happy to take a look. But I'll save like the thorough looking through the options, showing you the volatility and all that stuff. I'll save all that for the video tomorrow. Shamgar says, when you place covered calls in your strangles, do you use your cost basis based on your purchase of your puts without the premiums you collected, or do you figure in your premiums for your cost basis? If you watch the videos from the covered strangle playlist, it'll walk through all of that for you. So let me grab, and then obviously I'll give you a Cliff Notes version, but the covered strangle playlist will go through all of that. Where's it at? Here. So Shamgar, that playlist is for you. That's on the covered strangle. Here's the reality. Adjusted cost basis is fucking fake. It's literally fake. It doesn't mean anything. It is it's the most massive coping mechanism for people that cannot handle losing positions. It's literally like a child that's covering their ears and closing their eyes because they don't want to see something, except instead of it being a monster that's in your mind, it's your parents telling you to do something you don't want to do. It's literally children. And here's why it's children. Because when you sell options, so if we grab our handy dandy notebook. So if I sell, let's say I sell to open a put. So I sold to open one put, let's just call it like a 10 put, and I get $1. If you wanted to include this into this basis, if you're assigned, I don't hate that. I don't do it. I don't hate it though. I can see a more logical tie to this. And the way that I think about it is use what your brokerage platform gives you. The majority of brokerage platforms don't do this. Here's the issue. The basis is whatever the basis is. That's it. People don't like that. People will say, my basis is 20, but the stock is at 10, but I sold all these calls over here, so my basis isn't 20. My basis is actually 15, so I'm doing better. It doesn't mean anything. It literally doesn't mean anything. What we're doing is taking money from another trade and just applying it in another spot. It is the quintessential definition of bullshit mental gymnastics because you don't like reality. Not you personally, but the person that does this. If you show me somebody that does this kind of accounting and does this adjusted cost basis bullshit for selling calls, I guarantee you I can show somebody that has a problem with losing trades, that is completely immature with respect to the realities of trading. That's facts. So what we're like, to make this example a little more clear, maybe, is let's say that I also bought an option in something else. Let's say I bought to open a call, and let's say that this one's an XYZ or XZY, since I'm dyslexic and started writing it that way. So let's say you bought your call, and let's say while this one went down, XZY went up, and let's say you made $1 on this one. Do we take the $1 from this one and put it into this one? No. It's a different fucking trade. So the ultimate summary for all of this, though, is that regardless if you do it this way or if you just keep your basis at whatever it is, it's all going to come out in the wash. Your aggregate P&L is the exact same. So I think it's so much better and way more beneficial to the trader to just accept the basis as whatever it is. Don't do this bullshit of trying to adjust your basis using money from other trades, because then if we're rolling the call, do we adjust our basis up? I've never heard of anybody do that, which is interesting. Weird, huh? But we're okay with adjusting it to the side that's favorable to us. Doesn't make any sense. Reese says, Nike, what do you make of names that show strength in a market like this? Well, I think Nike has just been looking really terrible. I think it's too early to tell in terms of showing market strength because they're also moving on news. So it's not the same thing. If it's something that is moving because of overall strength, that's one story. But I don't think that's the story as it sits right now with Nike. Because if I look at Nike in a broader context, it's terrible. So I think the movement that you're seeing in Nike is a movement that's coming from a company that's been cut in half plus over the last 3 years. And they still have a viable business. They can only go so low. And I think it's mostly that tied with some news. So I do think that, to your broader point, that there are pockets of strength that you will find right now today. We can literally run a scan and see what did that exact thing for us because it exists. I look at it every single day. And there are always names that do this for us, that perform. But this wouldn't be one of them in my world, personally. So if we take a look at things that have had a pretty solid day, that have had a completely different story. I'm so stupid. So I literally was going down to type in the ticker, but I forgot that I pulled out this little drawing pad here. This is what I draw on for you guys. And I was like about to type in on the drawing pad instead of the keyboard. Totally missed that. But something like this. CYD. CYD has been crushing it. And it's been crushing it since the 14th. This popped up on my list on this day. And this is a simple, literally just long trade. Now, I don't love the overall ticker. The reason why I don't love it is because I'm not a big fan in investing in Chinese companies. It's just because I don't have enough confidence in their reporting. I just know that the way that they do accounting is different and there is some fuckery afoot sometimes. But I won't deny movements either. So as soon as this thing started showing this kind of strength on this kind of volume literally went from 23,000 up to 270,000 over the course of a day, right? So with that kind of movement, that was an easy choice. So there's a lot of strength right now in Chinese companies. LINC is another that's been showing strength for a while now. Another is CMPX. All of these are up on the day, by the way. The reason why CMPX is on here, by the way, it might not look as impressive because it's down 8% over the last 5 days. But over the last year, it's 73%. 6 months is 146%. So the company is still doing very, very well. CURI is another one. HIMS just got smashed. HIMS just got taken out to the woodshed. So yeah, HIMS is a different story. HIMS just got castrated is what I would frame this as. I got to pop the door for Thor. And yeah, anyways, there's a ton of names like this. And you'll also find, like I showed you a little bit earlier, that there is strength in utilities. Here. Same thing with staples, by the way. Here, actually, instead, oh, I forgot it's on this. I'm gonna run a scan, and then we'll just look at utilities directly versus just that. So let's do sector scan, and then let's find some sort of utilities. Yo, this thing, I don't know why this continues to lock up when this is going. Makes me mad though. All right, so let's see what utility companies are running it right now. LINC, funny enough, we literally just talked about that one. PRKS is doing it. CURI. So there's a bunch of these names that you can see that are clearly showing strength. So you can find pockets of that pretty much all over. All right. H says, what's your opinion on automating strategies? I have a team that wants to get their feet wet automating, but in testing systems for them to automate, it's much harder than I thought. That's a tough one. I don't really know what you mean by a team. Like, do you just mean like other friends, or do you mean like, what does that mean? I think the broader answer though for you, Senor H, is the only reason really to automate as a retail trader is if you find some monicum of convenience from it, but you're not going to find like edge automating. Your edge is going to have to be found somewhere else. Now, what I would say is that if I personally had a passion for automating things, I would go work at a quant fund, or I would go work at a high frequency trading firm and literally just make money for the firm on a salary. You'll definitely do way better than that. H says a few well-versed coders. Yeah, okay. Yeah, then I think other than you guys being able to conveniently build stuff to help simplify stuff, like you're not going to be able to automate anything that's going to be even remotely competitive. So I think in that kind of scenario, if you guys want to do it as like a project because it's fun, then sure, I get that. But if I wanted to do that and actually make money, I would go into the prediction markets, or I would go into crypto and find ways to essentially market make, because that's a way to use your automation for good. And obviously by good for you, I mean, not general good, but you can monetize it, right? You can make some money from it, which is clearly the goal. So I think in that sense, that's cool. But outside of that, it's just going to be for your convenience. There's the ability to code is definitely a weapon, but it doesn't help with edge. Edge is understanding market mechanics and forces. And unfortunately, you're not going to compete with any of the actual, because as soon as you're starting to try to compete from the lens of execution speed, right? And competing in a speed-based realm, now you're fighting people. It's beyond David versus Goliath. It's like David versus Godzilla. These firms, they literally bid to be closer to the exchange so that their latency is decreased, literally via physical proximity. It's a whole other level to this shit. H says, thanks for the feedback. We've considered and built systems for alerts for arbing between books on prediction markets, but haven't messed with market making. The hope was to create a system. Yeah, I think you'll find way more opportunity in the prediction markets. This is exactly what I would do. And it's because in the prediction markets, they're new enough that you can absolutely build your own edge there now as a retail trader. And it's because institutions have not bled into it yet. So the time is actually ticking though, in order for you to be able to do that. The reason why I don't personally do it, honestly, is because the markets aren't big enough for it to make sense for me. I make more money trading regularly. If I didn't and I was enterprising, that is 100% what I would be doing right now. Is I would either be cross exchange arbitrage or making sure to pay very close attention to the contract terms. You have to pay attention to the contract terms, because I've seen people not look at that closely enough and they think they're running an ARB, but they're not. So that's a fun fact. But I think that's exactly where I would go. But yeah, the issue is like you can make maybe a couple $100,000 a year if you have a good setup, a quick system, and good risk management, but it's just not worth it. But you'll be way better off there than somewhere like trying to automate anything on an actual exchange. You'll get fucking raped. There's just no way. Joseph says, does mark-to-market accounting apply to options trading? If you elect it, yeah, it's up to you. Lauren says, can you look at BB? Fuck yeah. Oh, this is funny. I literally looked at this today myself. Lauren, talk to me. What's the idea in here? What are we trying to do? Right now, I'm just getting my bearings. Three years. When was this? Late 23. Late 23. So it's already broken through this overhead resistance, which is good. It has another volume node up here. But there's not a lot of overhead resistance for anything that's like near term. I know that there is this deep stuff from a long time ago out here. But yeah, it looks like this looks like it's generally moving. I think this, like these breakouts are really, really solid form. Right? Sideways consolidation for a couple days, narrowing bars, volume expansion, like all those read really, really well. So I like that. I think now I don't like this move that much. I would be in the camp of really wanting to see how it consolidates here and then decide if it's viable for another breakout. But I haven't like actually done a thorough analysis on it. Give me one sec. I want to take a look. Where did I do? Let's see. Stock market analysis for BB. Want to know what the latest is. So what I do is in ChatGPT, I have a project called Market Research, and then within those projects, I have different conversations. So then what I do is I build essentially templates to templatize as it's doing different analysis for me. Let's read this article. So they announced plans to explore options for its Silence business, aiming to redirect investments towards high growth areas. Moves and aligns the company strategy to enhance focus on profitable segments like secure communications and IoT. That makes a lot of sense, specifically the secure communications element for them, because BlackBerry really has that dialed in. I would have to say, like, pretty well. They've been the premier for a long time. So entities that require any sort of secure style communications, they really do frequent BlackBerry for that. So they have a good sitting for it. Exploring options for the Silence business, sending shares of the Canadian company more than 4%. It was looking to redirect spending, so we already talked about that. It expects Silence, which uses machine learning to preempt security breaches. That's cool as fuck. To post an adjusted core loss of 51 million during the fiscal year. It's primarily transitioned to selling software for devices and autonomous vehicles and bought Silence in 19 for 1.4. This is an interesting example, though, of a company that's trying to pivot. And like it's doing okay on the pivot. Let's take a look at the options chain. Yeah, people are super bullish. Look at that. 362,000 calls against 62,000 puts. So yeah, I mean, this thing's really, really well positioned. Most of the people, funny enough, are playing way near term. Oh no, they're not. They're out in 20 June and 16 Jan. Okay, that makes way more sense. I thought it was 21 March. I was like, yo, that's way earlier than I thought. Yeah, most of these are 16 Jan. Yeah. I like this, honestly, from like a pot odds perspective kind of play. I mean, this is also super cheap, right? I think the vol out here is a little cheaper, 82%. So the surface will be a little expensive, but not crazy. Yeah, I like it. I think it's good. I think the name of the game here for it is I wouldn't want to see it really fall below this previous surge up, right? Because if it starts falling below this, then the trend looks kind of dangerous. Like I actually don't like that it's falling below this consolidation. That's this line that I drew here. It's kind of this little zone that you see between these three candles. This consolidation matters because this is after it had its little surge, couple trickle up days, then went sideways. Normally when we have stuff that's behaving like really well from a breakout slash near term momentum style play, you'll see them stay within this range versus starting to to play with it and to fall below it. So I don't fully love that end of it, but I mean, I still think that's okay. Yeah, I think it looks good. It's pretty solid. All right, take a look maybe at one more before I gotta bounce. Let me see. Tommy says EXC. Yeah, EXC looks great. How'd they do on earnings? Man, look at these. These are old. These are old. These are completely irrelevant. How'd it do on earnings? Good earnings beat. Solid behavior on a dividend day. Yeah, this looks great. The other thing that I like about this is that it's behaved really well over the last, I mean, essentially from mid-December, which is where a lot of other utilities companies were suffering. So this has been, these guys have been looking really, really good. Great call. Let's learn about their business. So they are like the majority of their industry's market cap. They are competing with Duke, which is interesting. Let me go to ChatGPT. Stock analysis for EXC. EXC. It's like completely locked up. No, I wanted to use my format, bro. So they expect to invest 3.8 billion over the next 4 years into infrastructure upgrades. The company has identified over 11 gigawatts of potential data center demand growth within its service areas. Fucking A. That's awesome. That's awesome. I'm waiting for the rest of ChatGPT's analysis. Here. Stock analysis for EXC. And then let's go through here. Sliders. What do I want here? Yeah, I like that it has like a moderate yield for utilities company. I don't like when utilities have too high of a yield, and that's primarily because I prefer utilities companies that are successfully expanding and growing. So if we take a look, yeah, their net income looks good. A little high on liabilities, but that's not abnormal for companies like this. Yeah, I think this one looks really, really solid, to be honest. And I love that they're pretty deeply involved in the nuclear power space, because that's about to be much, much less deregulated. So that'll favor this company pretty heavily. Awesome. Yeah, great call out. I love that name. Good find. That might be one to add to the ratio call diagonal list, because a couple of the others that I would prefer to trade have been moving too slow, kind of like the SMRs, the CEGs, right? So like if we take a look at CEG, right? Wrong way. SMR, wrong way. So the fact that these also trade a little bit like tech, not quite like tech, but definitely a little more tech than what we see in EXC. So yeah, I dig it. Sweet. All right, gang. Time for me to wrap up. If you need anything, hit me up in the Discord. Don't forget, we have our skills development stream on Wednesday on the Outlier trade process. It's to help you create a structure around building and actually placing, managing trades. And then Friday's Outlier options trading basics stream will be navigating the options chain. So as always, be an outlier. I'll see y'all later.